6:23 on Talking Property with Peter Esho, and joining us in the studio, Charbel Azzi from Lionheart Lawyers. G'day, mate. How you going?
I'm well, Bill. How are you?
I'm fine, thanks. Now, we're going to talk about purchasing in different entities here, and this is really important. We discussed it earlier in the show. Do you put the home in... And as Peter quite rightly said, a lot of times you're trying to get that property and then you forget, what do you put on the contract? Is it a company? Is it an individual's name? Is it both your names? All those things. First of all, in what entity should you purchase the family home?
It's always very exciting when you're buying property, particularly a family home. And the unfortunate thing is some people, particularly when they go to auction, they don't carefully consider in what entity they should buy properties, or whether it should be in their personal name, in either jointly with their partner or separately, whether it should be in a company or trust. When we're talking about the family home, usually a family home is going to be a principal place of residence. So I would generally advise that you do it in your individual name. The reason being is that you'll be exempt from capital gains when you sell, you'll be exempt from land tax as you hold the property, and you also may get some first home owner scheme benefits, such as a grant or some concessions to stamp duty, provided that it's within the regulated price range.
So, Charbel, that's the family home. When we come to an investment property, whether residential or commercial, what entity is preferred there?
Well, with an investment property, it's obviously not going to be your personal place of residence. So you will need to pay capital gains when you sell it down the track. Once again, I'd say here the best way to do it is in your individual name or jointly with a partner. The reason being, you'll be eligible for a 50% concessional discount on the capital gain later on down the track when you do sell the property. So essentially, what will happen is you get the sale price, you'll deduct from the sale price the total cost of that property. That'll be your income on which you'll need to pay a capital gains tax on. You'll have a 50% discount on that amount.
But if you buy it through a company, you're not entitled to that. Is that correct?
That's correct, yes. Okay. If you buy it in a company, you're not entitled to the capital gain discount.
Okay, what about a curly one? Let's say you want to invest in property, but you're planning on developing or building some shops or something a little bit more complex, and you don't want to expose yourself personally to a million things that could occur.
That's right. You certainly wouldn't want to be joined into proceedings or liable for any building defects down the track. So here I say, no, don't put it in your personal name, but rather put it in a company or in a unit trust. Now, if you compare the two, a company will have the benefit of a 30% tax rate on your rental income and capital gain. But in a unit trust, you'll pay tax at your personal rate if you're the unit holder for the income distribution from your trust. On the other hand, however, we just talked about income. When you go to sell that property or properties, if it's in a unit trust, you will be able to claim the 50% capital gain discount, but in a company you won't. So you'd need to speak with a solicitor or your accountant as to where you'll receive the greater benefit on income or capital. Okay,
so let's just recap for people that have maybe just tuned in or been listening to this. Family home, we said personal name.
Generally speaking, family home, individual name's the way to go so that you do get your exemptions and concessions. Investment property, once again, so that you get your CGT concession, individual names. If you're looking to build down the track, then you've got to consider liability issues. That's where you look at a company or a unit trust.
One of the things my wife and I talk about a lot is purchasing investments. So when our kids grow up, we sort of hand something over to them. And I think a lot of parents will be thinking the same thing, or you might have different types of scenarios, brothers and sisters and family members getting together. What if you do have those family scenarios and you do want to plan for one day of sharing that income around? Or
Yeah, that's a very good question. This is a space where you would look at a family trust. Now, a lot of people hear of a family trust, but they don't know much about it. A family trust usually will specify you or you and your spouse as a specified beneficiary, and then around you there'll be categories of designated beneficiaries such as descendants or parents or uncles and aunties. This will allow you, if you're the trustee or control the company trust, to essentially distribute income to certain members within the family. And you might, obviously look to those who are the lower income earning members of the family to reduce your income tax. Now, the disadvantage of having property in a family trust is that you won't be eligible for the land tax threshold of about $480,000. So you will be paying land tax on every dollar of value of land.
Dual occupancy. You got a block of land, you put another building on it once it's approved. Whose name would you put that in? Or is that just, again, like another investment property, you've got the option?
Once again, if you're going to build, you're going to be concerned about liability issues. So you'd put in a unit trust.
Right.
If you then want to distribute the rental income from the property to various family members, well, then you'll have the family trust owning the units of the unit trust that owns the property.
Right.
So these are issues that I highly recommend people get legal advice on before they go to auction and exchange, because once they do that, it could be too late if they want to change the owner. They could be up for double duty.
Got a call from Colin here. G'day, Colin. You got a question for Charbel?
Yes, we have. We've helped two of our kids by going as guarantors with the equity in our house. We've retired. Our house currently is worth about $750, and we owe about $130 on it, and we put about $130 as guarantor for each of our two boys. So there's about $400,000 worth of equity taken up. What we're thinking, our other child, we're probably not in a position to do that, but what they were thinking about was to extend our house up rather than out into a granny flat situation. But with the loan in their name on our property. Wondering whether that sort of thing is something.
Is that possible? I think that's more of a lending question, Charbel,
Yeah.
and that comes down to what the banks would prefer. But generally, if title is in the parent's name and they want to build a granny flat and they want the child to fork that out, is there a legal aspect there that you can comment on, or is it really more of a lending issue?
Yeah, unfortunately, I didn't hear the early part of that question. My headset wasn't on, but
He was listening to the footy, actually. But no, I'm only kidding.
If you and your wife or your spouse de facto own a property, and you're looking to build a granny flat, you want to raise some funds to do that. The bank might not give you some funds because your income capacity might not be so high. So you might ask one of your children to assist. There's a number of things that you could do. They could be guarantors under the loan. You could seek to put one of your children on the title. However, you will need to pay stamp duty for that transfer or proportionate transfer of title to your children.
Thanks for your call, Colin. Peter, good evening.
How you going?
Fine, thank you. You got a question for Charbel?
Yes, please.
Fire away.
I bought a property with my dad, shared with my dad about 10 years ago. And last year I bought a property of mine. So I'm looking to transfer the first property just under my dad's name. So I was just wondering what's the cost are and what's the procedures.
Yeah, Peter, thank you for your call. What you'll need to do is transfer. So you hold that property in equal shares between you and your father?
That's right.
And that was bought post 1985 because it was only 10 years ago.
Yeah.
So what you'll need to do is essentially transfer the property from your father into your name.
No, from my name to my dad's name.
Okay, so you want the full property held by your dad?
Yes.
Okay, so essentially what you'll need to do is obtain a valuation on that property. You'll need to pay stamp duty on the transfer, and there will be a capital gains tax. However, you will be eligible for the 50% discount on that capital gain.
Okay.
So capital gains tax implications there, and also stamp duty implications.
And
that's why it's very important to get it done right at the beginning, right? Which is exactly the points that you started talking about. That first transaction is essential to get.
And maybe in Peter's case, circumstances have changed. Thanks for your call, Peter. Does that answer your question?
Yes. Thank you very much.
Thanks, mate. Thanks for your call. And I can't ever imagine my kids giving me any half their property. That's for sure. I hope it happens. Ahmed, you got a question for Charbel?
Yeah, how you doing, guys? Lovely show, by the way.
Thank you.
Mr. Charbel, yes. So I'll just give you a scenario, right, for a residential investment. So if you have it in your in a family trust, so for example, Ahmed as trustee for X family trust, right?
Yes.
Okay. So what's the implications here on, first of all, capital gains and land tax?
Okay. Well, property that's owned in your family trust will not receive the benefit of the land tax threshold. So you will be paying land tax for as long as you hold the property for every dollar of value that's in that family trust. And that's land tax is on the value of the land. So that's different to the value of the land and the dwelling or the building on the land.
Correct.
Now, in terms of capital gains, provided that the income distribution is going to an individual, so in the family trust, provided that the income on sale or rent is going to an individual, then you will pay capital gains, but once again, you'll be eligible for the 50% discount. There may be other circumstances which could or essentially change that advice, but essentially they're the key general points. And for any, I always advise that you receive some specific legal advice from a solicitor, or feel free to call Lionheart Lawyers tomorrow, and we can assist more specifically.
Sure. Just quickly, how about self-managed super funds? Is it the same? What's the implication?
That's funny. I'm glad you asked that, Ahmed, because I was going to get that question to Charbel before he left, so you've asked it for me.
Yeah. So self-managed super fund, the income tax rate is a reduced rate of 15%. That's why they're so popular. However, if the self-managed super fund is in pension mode, which means that the fund is paying a minimum pension depending on the age of the beneficiary, usually transitional period between 55 to 60, and then above 60 you'll be able to do this. The income tax rate is nil. In terms of CGT, capital gains tax, it's only paid on 2/3 of the capital gain rather than the full gain. But once again, if it's in pension mode, it's nil. The disadvantage is that you can't access all of the funds or the assets until you're at that age where you can access it above 60, usually.
Okay, so theoretically your self-managed fund can sell that property and have a liquid, amount of money in their account and allocate that in pension mode after the age of 60.
That's right.
Right.
And
of course, you're not gaining on it other than your interest, but So, is that to answer your questions, Ahmed?
Yes. And also land tax, again, you pay every dollar as well, for land tax for super funds as well?
That's a good question. How about you call me tomorrow and I'll answer that one?
A bit more complicated, is it?
Not necessarily. I just, off the top of my head, I can't recall whether the threshold applies or not, but I'm quite or whether you do pay it. So that's something I'll have to answer another day.
Right. No worries at all. Thank you. Thanks, guys.
No, thanks Ahmed.